we're going further into debt, buying government debt. They're buying our debt, the UK is, and we're going further into debt in order to buy commodities like oil and energy production from the BRICS countries, who instead of, they sell us their oil. And what are we doing? What are they doing with the proceeds? They're buying gold. Instead of putting it into treasuries, they're buying gold. And we're creating more debt in order to buy energy from these countries, used to buy our debt. This is a doom loop in the respect that these BRICS nations continue to pile into gold and other commodities with the proceeds of the energy we buy from them and the commodities we buy from them, which only pushes those prices up higher.
The global economic dynamics are shifting dramatically, and the implications for the US are alarming. For decades, the US has enjoyed a lifestyle supported by foreign creditors, but this era is rapidly ending. The US debt has skyrocketed, with the Treasury Department reporting an increase from $33.9 trillion to $34.86 trillion in just 6 months. This unsustainable debt acceleration poses a significant threat to the dollar's value. As countries pivot from the dollar, demand for US Treasuries will decline, leading to higher interest rates and further economic turmoil. The US economy heavily relies on foreign investments and the dollar's stability. However, the BRICS alliance's move towards gold-backed currencies threatens the dollar's reserve status. This shift could result in a massive return of dollars to the US, causing hyperinflation and economic instability. Countries like China, India, and Russia are increasing their gold reserves and reducing their US Treasury holdings. If this trend continues, the US might struggle to finance its debt without extreme measures like printing more money, leading to even higher inflation and a potential economic collapse. Andy Schectman, CEO of Miles Franklin, emphasizes that the increasing number of nations choosing a non-dollar-based settlement system supported by gold reserves is driving upward pressure on gold prices. This shift challenges Western financial hegemony, expanding the sphere of influence of these nations and enhancing their economic resilience. Moves like India's repatriation of gold from foreign banks highlight a broader global realignment where trust in gold as a stable asset outweighs the risks of fluctuating bond markets. The potential mass adoption of this new settlement system poses a direct challenge to long-standing financial norms, potentially reshaping the geopolitical landscape in profound and unforeseen ways. This trend is a stark warning from Andy that the era of unquestioned US financial dominance may be drawing to a close, necessitating urgent attention and action. We will present clips from Andy Schectman's interview. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
We're all aware that China and now even Japan, to a degree, Russia, Saudi Arabia, they've all been selling bonds. Let's just say the BRICS nations have been selling bonds, right? At the same time, arguably, they're buying gold, which we can see. At the same time, the United States and the United Kingdom and these Western nations that we're supposed to believe are buying our bonds are going further into debt. We're going further into debt, buying government debt. They're buying our debt, the UK is, and we're going further into debt in order to buy commodities like oil and energy production from the BRICS countries, who instead of, they sell us their oil. And what are we doing? What are they doing with the proceeds? They're buying gold. Instead of putting it into treasuries, they're buying gold. And we're creating more debt in order to buy energy from these countries. They used to buy our debt, but now they don't. So we have to sell that debt to the UK and to the Cayman Islands and Ireland, if you believe that. But this is a doom loop in the respect that these BRICS nations continue to pile into gold and other commodities with the proceeds of the energy we buy from them and the commodities we buy from them, which only pushes those prices up higher. And when you talk about gold going higher, as part of the new BRICS currency settlement, which will be deliverable, this just falls right into the hands of the BRICS countries. So the longer they wait, the higher the price goes in gold. And the more reliant the West is upon them for these commodities. And at the same time, you have a massive growing mass 59 more countries said they want to join coming out of Novograd 2 weeks ago. This is something that when you have more and more and more and more countries sign on officially, all accepting a common settlement currency that is not US dollars, that is settling in essence in gold, which is 40% gold, which is deliverable, which is held within the own borders of these countries. And that's a very important point here. If you're in the unit white paper, it talks each one of these countries will hold their own gold. So when you see this mass repatriation effort, and in particular, India is a good example, repatriating 100 metric tons they've held at the B of A, excuse me, at the Bank of England, B of E, Bank of England since 1991, and all of the countries repatriating their gold from the New York Fed. Well, that makes sense. These countries understand they can hold their own gold. They'll continue to buy gold because it will be what they settle in, which has outperformed the bond market 2-to-1 over the last 25 years with no counterparty risk. So the longer they wait, the more countries join on, the higher the price of gold is going to go, and the more trouble that the West will have in I think finding natural resources and people willing to hold their debt. So would it surprise me if they issued it in October? No, it wouldn't. But I think it would also not surprise me if they waited another year, to your point, in 2025. And James Rickards has an interesting take on it. He says, yeah, it's all about mass adoption, that right now there's 10 countries that they can shop with if they had a common settlement currency. 10. What happens if it's 69? If they said, fine, the other 59 are in. Now you can buy goods and services from 69 countries instead of from 10, which was previously 5. And pretty soon you have such a massive swath of GDP, human population, commodities, shipping lanes, military might, that not only is it a massive, massive real entity in every single way, but then issuing that common settlement currency, it's almost 100% guarantee that it works, to a massive detriment to the dollar, to the Treasury market, and to the way things have always been in this country.
The petrodollar deal between the United States and Saudi Arabia, established in 1974, ended in June after 50 years. This agreement required major oil producers like Saudi Arabia to price their exports exclusively in US dollars, cementing the dollar's position as the world's primary reserve currency. Saudi Arabia's decision not to renew this agreement has stirred significant unease in global financial markets regarding the future of the US dollar. The shift away from the petrodollar system represents a notable transfer of power from the West to the East, a transformation unfolding gradually over the years. Major corporations have relocated production from Western nations to Eastern countries, notably China, granting Eastern powers control over significant portions of the global supply chain. The economic impact on the United States is significant. The petrodollar system ensured a steady demand for US dollars, which was crucial for stabilizing its status as the global reserve currency. However, with its dissolution, the US economy risks heightened volatility. Exchange rates and financial markets could see substantial fluctuations, potentially destabilizing the economy. The system's stability also facilitated international trade and provided a dependable market for US debt. Without it, the US may face more frequent economic disruptions and less certainty in financial conditions.
Yeah, well, I have a hard time. I've said forever, I can't imagine that they would lower rates, and they haven't so far. I mean, remember, there was going to be 4 or 5 cuts for sure, and then, well, maybe one, and then maybe none. Maybe they're going to raise, and there's $14 trillion in debt that needs to be retired this year as maturing debt, or to pay interest expenses, or to cover the ridiculous amount of irresponsible fiscal spending and deficits of our government. How the hell do they come up with that? Maybe you can, as rates have been going down, what you are seeing is the Fed intervening already through, as Jim Willey puts it, the UK and Ireland and the Cayman Islands funneling money under the table. Because look, when you have a situation where more bonds are sold than are bought, rates rise, right? But when more supply, that's more supply than demand. But when more bonds are bought than are sold, rates fall. So we're supposed to believe that someone is interested in buying our 10-year treasuries, and they are doing so to drive rates down. I just have a hard time just a hard time believing anyone would be buying our bonds right now when we see Russia and China and Japan dumping our bonds right now. I have a hard, who the hell's buying it? Is it monetization? I think it's important to remember. There it is, right there. And I think it's important to remember
He's a
what
buyer
Lieberman,
of bonds right now, I hear.
he said, there is no means of avoiding the final collapse of a boom brought about by credit expansion. The alternative is only whether the crisis should come sooner as a result of voluntary abandonment of further credit expansion. Well, we're not there yet, or later as a final and total catastrophe of the currency system involved. We're heading in that direction. You lower rates, you have acquiesced once again. You're just going to reignite inflation. Yeah, the numbers they tell us are all fugazi. You can't believe them. Inflation is way higher than they're telling us. And this is a politicized event by the Fed to lower rates 2 months before the election. And yeah, if they do it, fine. But I think it's stupid, and they'll never normalize their balance sheet. And it just signals to the world, why the hell would you want to sell us your oil or your commodities for a currency that once again will give in to inflation over austerity? And once again is rigged. I mean, it's rigged in every way, even in the way that they measure all of the numbers to gauge their policy decision, including unemployment numbers. And if they hired John Williams instead of the Bureau of Labor Statistics, maybe we would be able to direct monetary policy to right the ship. But what they are doing by giving in and lowering rates is the worst thing that they can do, and just giving up on ever getting this house in order. And it would start with stop spending. And the spending that we do is ridiculous. $100,000 per second is the amount of debt that we are creating. That's $1 trillion every 100 days. And not slowing down. So yeah, if you believe that inflation is where it is, I got a bridge to sell you. And that's why you take a look at all of these markets that just keep going straight up when compared against, against like the 10-year Treasury. When you're comparing it, all of these markets are going straight up. All that money that's been created and poured into the system, whether it be gold or Bitcoin or the S&P or the NASDAQ, all of these things are shooting up because of all this money, and that will just keep it going higher. So it's good for gold. It's good for the market. And ultimately, it's not good for this country. So yeah, they'll probably lower rates, but I think it's really a dumb thing because it's only going to make a bad situation ultimately worse.
The alleged expiration of the petrodollar agreement signals a potential end to the fiat currency era, marking a shift back to commodity-backed money. Experts like Andy and others foresee significant global financial changes ahead. As countries no longer require US dollars exclusively for oil purchases, these dollars may flow back into the US, potentially leading to higher inflation and interest rates. However, amidst this shift, gold's role in the new financial landscape suggests a move towards a system emphasizing commodities and transparency. Share your thoughts on Andy's prediction in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.